Thank you all very much for joining us this morning. I'm Steve McMenamin. I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning is weighing the needs of investors. This is a continuation of our examining the issues that affect investors. Today we'll hear from one of the most vocal investor advocates in the business. I'll briefly introduce him. John Bogle founded the Vanguard Group in 1974. He served as chairman and chief executive until 1996. Vanguard is one of the two largest mutual fund companies in the world, managing over $1 trillion in assets. Jack is the father of the modern index fund and is very definitely a legend. In 2004, Time magazine named Mr. Bogle as one of the world's 100 most powerful and influential people, and Fortune named him one of the giants of the 21st century, or 20th century, I should say.
We're working on the 21st.
To Mr. Bogle's right, Ed Barksdale is the moderator of the Greenwich Roundtable today. Ed runs Federal Street Partners, a highly respected hedge fund of funds. Before that, he was the CEO of Northern Trust Global Advisors and the founder of Rogers, Casey and Barksdale. Ed is a trustee of the Roundtable and a member of our External Affairs Committee. Please welcome Ed as he frames today's discussion.
Well, thank you. Originally, we were going to have another speaker as well, Bob Steele. And so my role was going to be to make sure that questions were properly directed and so forth. But unfortunately, Bob was at a very last-minute call to testify before our esteemed Congress this morning. And so he's not with us. So my role has changed a little bit. It's interesting having admired and on occasion vilified Jack for his focus on passive management, since I've always been on the side of active management. My role has shifted a little bit to be more of a thorn in his side as we go through and to make sure that you have an active discussion. I flatter myself by saying I feel a little bit like Muhammad Ali's sparring partner as he was warming up for the George Foreman fight many years ago. But I think we'll have an interesting discussion. And Jack certainly needs no introduction from Steve or from me. He's well known to all of us and has some interesting remarks for us. So, Jack?
Okay, thank you. Can you all hear me all right? Is that mic close enough? Thank you very much, Ed. I feel, I have to confess, a little bit like Daniel in the Lion's Den, with so many people that are interested in active management. But I'm, I think, comforted by the fact that I'm just going to guess, if my experience with other groups is any indication at all, that I'm going to find myself with quite a few, maybe not in your professional lives, but in your personal lives, quite a few Vanguard shareholders in the room. I won't embarrass anybody by asking for a show of hands, and I won't embarrass myself by the fact that it may be a very small show of hands, but I'm just going to guess a little bit about that. And I'm delighted to be here this morning, obviously, to talk about the needs of investors. I'm not sure exactly what weighing is, but I want to make just a few basic points to get the conversation going. And that is, in this recent era, with its glorious financial excesses, I think our investment community has developed a vested interest in ignoring the most conspicuous of all realities of financial market returns. It's been said, I think, by my detractors that I have the uncanny ability to recognize the obvious. And it's a particularly ironic statement, since the obvious is by definition something anybody can recognize. But in any event, that's all I have going for me. And my new little book on common sense investing, which thanks to Steve and the Roundtable, you're going to, I think, have copies given to you outside after the meeting, is really about the obvious, simply because so many people in our field, even the professionals, seem unwilling to recognize it. This is not a new problem. I think it was 2.5 millennia ago, Demosthenes warned that what each man wishes, that he also believes to be true. And more recently, in kind of a pungent and less charitable quote, Upton Sinclair marveled that it's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. But we have to understand it. Because
sometimes they're not so small.
Yeah, exactly. It's central to the operation system of financial intermediation that underlies the collective wealth of our citizens and clients and personal assets. And the overarching reality, which I don't want to spend too much time because you're aware of this, is that is gross return in the financial markets minus the cost of financial intermediation equals the net return actually delivered to investors. I don't need to tell anybody in this room that while staggering amounts of the financial literature have been devoted to the efficient market hypothesis, the EMH, almost nothing, matter of fact, I don't think anybody but me uses this expression, has been devoted to what I call the CMH, the cost matters hypothesis. And to explain the odds that investors face in their quest to beat the market, we don't even need the EMH. I mean, the market is more or less efficient. I think we'd all agree with that. How we might disagree on a degree, but all we need is the CMH. No matter how efficient or inefficient the market may be, the returns earned by investors must and do and will fall short of the aggregate market returns by the aggregate costs they incur. Turns out to be around $400 billion a year is the cost of our financial system, very roughly. Nonetheless, the pages of our financial journals are filled with these statistical studies, and you see them as well as I do, of rates of market return that are neither achievable nor achieved. I often wonder how we can talk about creating positive alpha for investors without acknowledging that after intermediation costs, the system as a whole delivers negative alpha. No way around it. More interestingly still, of what use is speculating about the equity premium to any of us when 100% of the return on today's U.S. Treasury note is there for the taking, while the entire equity premium today can be consumed by the cost of our financial system. That cost is around us, I'll talk about in a moment, of about 2.5% for mutual funds. How can we ignore the impact of taxes, which almost everybody does, inflicted on our owners by the feverish transaction activity that we have, and I'm going to talk a little bit about that later on. And while I'm about it, how can we possibly continue to expect to express long-term stock market returns in nominal dollars rather than real dollars? I'll give you an example of how much it matters. When you compound the 13% nominal return on stocks over the past 25 years, a dollar goes to $21. But when we calculate the real return of 9.8% compounded, a dollar goes to $10.50, exactly one half as much, just compounding. Even worse, we deduct the 2.5%, yes, the 2.5% of the average cost of the mutual fund, taking into account sales loads, expense ratios, transaction costs, and opportunity costs. From this real return, that dollar grows to $5.90, another reduction of one half. That's all. And that $5.90 compared to $21 was achieved in one of the great eras, even including the burst in the bubble, in the U.S. stock market. Highly, we can talk about this later on, highly unlikely to be repeated in the foreseeable future. So the $21 return, capital accumulation, is an illusion, and the $5.90 is the reality of our business, at least in the mutual fund section. I want to be clear that when we're talking about the needs of investors, we ought to think about which investors, and I thought my fellow conversationalist this morning would talk a little bit about this, but I'll do it since he's not here. We want to be clear when we're talking about the needs of investors, just what investors, types of investors we're talking about. Are we talking about the institutional investors who do the investing? Are we talking about individual investors, those last line owners of our mutual funds and last line beneficiaries of our pension plans? This is a relatively new issue. In my previous book, the new book is called The Little Book of Common Sense Investing, subtitled The Only Way to Guarantee Your Fair Share of Market Return. In the previous book, I'm not hawking books here, by the way, but in the previous book, it came out, published by Yale University Press a year ago, or a year and a half ago, was entitled The Battle for the Soul of Capitalism. And I discuss in some depths the fact that we have a new agency society, I call it, it's developed over the past 5 years, which has completely supplanted the old ownership society. That's gone, and it doesn't matter what the administration says, that ownership society is never going to return. Today, financial institutions own, you know this, 68, probably 70% now of the shares of all our corporations. In 1950, that number was 8%. A revolution in ownership, in stock holdings, from an ownership system to an agency system in half a century. A lot of that failure, that agency system, I'll make the point, is failing, and a lot of that failure is summed up by Adam Smith's wonderful quote. I'm paraphrasing a little bit here. Corporate directors and managers of other people's money seldom watch over it with the same anxious vigilance that they watch over their own. Like the stewards of a rich man, they very easily give themselves a dispensation. I know a lot of you are in family offices. That issue doesn't exist, but we take I hope it doesn't exist. But we take better care of ourselves, or tend to, as human beings, than we take care of the needs of others. This is just as true as executive compensation in corporate America as it is of management fees in mutual fund America, and dare I say, management fees in hedge fund America. In each case, the ultimate shareholder, the client, dines at the bottom of the food chain. That is the harsh reality of our business. We all get paid, including Bogle, and the client gets what's left. But another particularly large, and I think a very interesting thing that has been not really recognized enough of the failure of this agency society is the change in focus of these largest financial institutions, not just hedge funds, but pension funds and mutual funds, which together own 55% or so of all stocks, from the wisdom of long-term investing to the folly of short-term speculation. My concern, which I express in the little book you're going to get, is that investors today, our giant financial institutions, every bit as much as our individual investors out there, are focused on the illusory expectations market rather than the real market of intrinsic business value. And while business values change, you all know this, only gradually, expectations change in real time with incredible rapidity. That obvious change can be quantified quite easily. Just think about this. While the average turnover of U.S. stocks was 20% during the 50s and during the 60s and during the 1970s, and the system seemed to function just fine. I was in it all those decades. And even around 50% through the early 1990s, crossed 100% in 1998 for the first time since 1929. And it's been running at amazing, this is equity turnover, and NASD and NYSE together, at 150%, 7 times the old norm of a half century ago and then even 30 years ago. This increase, to state the obvious, which I'm obliged to do, cannot possibly enrich stockholders as a group. It impoverishes them, and it's a blessing to, of course, the croupiers of Wall Street, even at today's vastly diminished commission rates. So we ought to acknowledge, this is the theme of the book, that owning American business, 3, I think, unarguable facts on owning American business, is in the long term a winning game, because businesses earn a return on their capital and distribute a major portion of those earnings in dividends. And 2, that beating the market before cost is a zero-sum game, and beating the market after cost is a loser's game. I call these principles, this is a great phrase from Justice Brandeis, back at, he said it in his book Other People's Money in around 1914. The relentless rule, he was talking about a different subject, but it applies equally well here. The relentless rules of humble arithmetic. So if we're going to create greater wealth to meet the needs of investors, the subject today, and create greater accumulations for investors, we in the investment profession have to focus on these 3 relentless rules of humble arithmetic: winning game, zero-sum game, and loser's game. Yet we're still all working, everybody in the room, including the actively managed funds at Vanguard, on the search for this holy grail of superior performance for our clients. It's not wrong. How can anybody argue it's wrong? But it's not the only thing that we ought to consider. And this is the point I want to make about all the work we do to serve clients, very good, is to seek a comparative advantage for ourselves over others. But we don't spend much time thinking about a community advantage that serves all of our clients as a group. So we have a very difficult system, pouring all these resources into a financial system. And the more resources we pour in, by definition, the more our clients in the aggregate lose. I'm bolstered by Charlie Munger, Warren Buffett's partner, who had this to say: most money-making activities contain profoundly antisocial effects. As high-cost modalities become ever more popular, the activity exacerbates the current harmful trend in which ever more of the nation's ethical young brain power is attracted the lucrative money management and its attendant modern frictions, as distinguished from work providing much more value to others. And Paul Samuelson, to name one, says exactly the same thing. And by the way, my new book is dedicated to him. He and I go back to, if I can throw in a little parenthetical here, to 1948, when studying his economics book at Princeton, first edition, almost cost me my scholarship there, because I did very poorly in it. And that would have been the end of my college career. But he's been a booster ever since then, I guess I'd say. He wasn't teaching it, but it was his book. He's, of course, at MIT. So as long as money management money-making activity simply shifts returns from, you could say, from the pedestrian to the brilliant, or you could say from the unlucky to the lucky, probably a little of each, or you could say from those who naively entrust the system to those who work at its margins, of course it has profoundly antisocial effects. So we ought to be thinking a little bit, when we're thinking about our own lives, thinking about making capitalism work better for all stock owners. We all have a vested interest in making sure it works for everyone. Those who are lucky, those who are wealthy, those who are smart, but those who are victims of the system. So we ought to, all of us, I think, ought to be thinking about that. Two things stand in the way of realizing this kind of a goal. One, of course, is money. This field has been immensely profitable to its participants. I should say at this point, though I know that firsthand because my son is a hedge fund manager. Might as well get it out on the table before someone challenges me. And I should say very successful when he runs a market-neutral portfolio up in the wealthy mass. And those vast sums of money, I think, have become kind of a narcotic. The second force probably is even more powerful, and that is the reliance of investors to have financial intermediaries to protect their interest. That ownership society that's gone brings ever fewer direct owners of our wealth-generating corporations. This intermediation society we live in, essentially the last line owners, the fund shareholders and pension beneficiaries, have to rely on their trustees to act as their faithful fiduciaries, yet largely because of this dollar-for-dollar trade-off in the money management business, in which the more managers take, by definition, the less investors make, there's not very much evidence of adequate stewardship to my jaundiced eye. So I think we ought to be thinking about, I encourage stock owners, beneficiaries, mutual fund shareholders to demand their stewards provide them with stewardship. And we'd have a better investment America, far better for our clients than it is today. I want to say just a couple of things about where hedge funds fit into this equation. For tax-exempt institutions with infinite time horizons, i.e. Princeton, Yale, Harvard, Duke, who have the assets to participate in hedge funds and the manpower needed to comply. You probably saw the comments in the Times yesterday from Andy Golden, who I'm actually going to see him this afternoon down at Princeton. He says it takes Princeton Investment Management Company 4,000 man-hours to select a hedge fund manager and 400 man-hours, I'm sorry, I think I said 4,000, 75 man-hours per year to monitor that hedge fund manager. And that's fine, there's nothing the matter with that. My God, they've done so well, it's quite unbelievable. Some scholarship money I've left at Princeton, thanks to Andy, is now educating 16 kids, and I didn't give him very much money. But he's been growing like the others have, about 15% a year. But for public investors, largely taxable, very short-term oriented in their focus, I don't think hedge funds make very much sense for them. And when you layer on the cost of the hedge funds of funds, I don't think they make any sense at all. My book is very clear on that being my opinion. I hear these rumors that there are going to be hedge fund of funds of funds, which will be a fund of funds that owns other fund of funds. And that may be taking it just one iteration too far. Let me say a word about the way I look at hedge fund returns, and Ed and I were talking about this earlier. I don't think the record achieved by hedge funds as a group, and some of them are terrific, as there's an old saying that says something like this: some of my best friends are hedge fund managers, and they are, as well as some of my relatives. But the record is, I think, nothing to write home about. You've probably seen the Malkiel study, a very distinguished academic study, about 8 years in length, through 2003. The average hedge fund provided 9.3%. Investors would have been better served, if you forget this little commercial here, by owning a low-cost balanced fund, balanced mutual fund. You make a big mistake by comparing hedge funds, which usually have either a short component or a fixed income component as a group, by comparing them solely with an equity fund or an equity index. The conservative Vanguard Wellington Fund, been plying its wares since 1928, that's where I started to work in 1951, returned 10.1%, not 9.3%, during the same period. It wasn't exceptional. Standard deviation was 9.9 for Wellington versus 10.4% for the average hedge fund. And of course, Wellington Fund had infinitely greater tax efficiency. We also have a balanced index fund. That didn't do quite that well, but it had about an 8.8% return compared to that hedge fund 9.3, an unmanaged 60-40, 60 stock, 40 bond balanced index fund with even greater tax efficiency than Wellington Fund, and of course than the hedge fund, and with about the same risk as Wellington and less than the hedge fund. So the past record isn't anything to write home about. Not that some hedge funds haven't done very well, but in the aggregate, which we have to look at, not so good. What's more, and this is really something that bothers me more than almost anything, many hedge funds that contributed to that record, the SEC estimates, shockingly enough, there were 400 of them achieved their success by virtue of, if I can use the word virtue, of illicit time zone trading in mutual funds. 400 funds describe their returns as market timing or time zone trading in mutual funds. That record will not recur. At least I don't think it will recur, because most funds have put in substantial barriers to those market timing schemes. And I have to say parenthetically, why our regulators didn't prosecute these cases, they didn't do very well than they did, as, to lay my cards right on the table, as a conspiracy by the fund managers and the hedge fund managers, the mutual fund management companies and the hedge fund managers, to defraud the long-term shareholders of the fund, I do not know, because that's what it was. And in addition, and you all know more about this than I do, but I suspect as the hedge fund community grows, and some of the smartest investors in this business are in it, more and more smart investors will be seeking out smaller and smaller inefficiencies in a market increasingly made efficient by all their very brain power and sophistication that they bring to the table. So their very existence makes a successful completion of their mission less and less likely in the future. And so I would say even that record would not be able to recur. I want to get just a couple of points at the end. Let's see if I can do that decently. Let me just say quickly, because I don't have used a little more of my time than I should. What is the best way then, given the title of this meeting, to serve the needs of the average investors? The man, as it were, in the street. And so let me close by my basic theory about that, based on the writings of the Greek philosopher Archilochus. He talks about the hedgehog and the fox. And his little fragment of writing that was left says, the fox knows many things, but the hedgehog knows one great thing. And the fox, of course, is that sly guy out there in the financial institutions that survives by knowing many things about complex markets and sophisticated marketing. And the hedgehog, of course, is that durable animal curling into a ball, lying there, passive, its spines giving it this great piece of impregnable armor. And that would be represented by the financial institution that knows only one great thing. And that's the great thing that I think index funds do. I might as well mention it. That in the long term, investment success is based on owning American business or even global business in its entirety and holding it forever. The mutual fund industry that I find myself in, and the investment business generally, the foxes hold sway, both investment philosophy and business philosophy, and there aren't many hedgehog firms out there, but I think Vanguard is one. And when you get into marketing, you see this even more clearly written in the way we do marketing in this business generally. The brokerage system, the mutual fund system, advertising hot funds, finding hot new products, of which the ETF is the most notable today, there are proper uses for ETFs, but I don't think many of them are being done. But the idea is to own the classic index fund, holding everything, trading almost never, charging no sales charges. This is to serve the needs of the investor. And without any management fees, with minimal operating expenses, no sales loads, no carry, and no nothing. delivering the fair share to investors of whatever returns our markets generate. Close with just these two brief thoughts. The reality of indexing. An index strategy for holding equities, or bonds for that matter, may not be the best strategy for serving investor needs that has ever been devised, but the number of strategies that are worse is infinite. Think about that one. And then think about this one other way. The index fund, I think unarguably, I don't think anybody in the room would disagree with this, is a good plan for serving the needs of investors. So I ask you all in conclusion, don't forget after Clausewitz, that the greatest enemy of a good plan is the dream of a perfect plan. I'm glad to take some questions.
Thank you, Jack. Representing the agile minds doing useless work around the table, and maybe a couple of foxes, could you give your sense of why, notwithstanding the dramatic increment of assets have been allocated to passive management, why is there still so much money actively managed, and why are we chasing what you would view as this dream that is unlikely to be achieved?
Okay, well, let me speak to it first from the perspective of the mutual fund industry. And it may be that the problems, to be quite blunt about it, the problems in the mutual fund industry are so deep and pervasive that the index fund is basically kind of giving a cheap shot. I mean, it's so much better than the normal mutual fund alternative. Let's just talk about that for a second. And why do people continually buy actively managed mutual funds or actively traded ETFs? And I should say parenthetically, Ed, that some of you may know this because I wrote a little bit about it in the Wall Street Journal op-ed a month ago. The index, classic indexing, S&P 500 kind of indexing, stopped growing as a percentage of equity fund assets at 10%, went from 0 to 10% from the time we started the first index fund in 1975 to 10% in 1999, and it stopped for all these advantages, and it's tragic. The big growth in indexing to 16% of those assets is ETFs, which are index funds that, as the ads say, can be traded all day long in real time. I don't know why anybody would want to do that. Seems not like a particularly good idea. But first, then, is the power of the marketing system of Wall Street, the idea of new ideas, the excitement, and all that of a marketing system, a very costly marketing system, too. Number two is the individual's tendency. Let me say number two is what we call, might as well use a good economic term, is information asymmetry. The seller knows a lot that the buyer doesn't know. Might as well face up to that. So if the index fund is something the buyer's interested in and went up 15% last year, the broker can always say, well, here's one that went up 30. Because in a 15% year, if there's not a fund that went up 30, I'm missing my guess. So and there may be a bunch of them that go up 30 in a given year. Related to that, so there's always the investor, the marketing system's weapon, and then always the weapon of the investor, which I think creates a lot of problems, and that is we all think we're above average. We think we're above average in our investment judgment. We think we're above average drivers. I read somewhere that we all think we're above average lovers. But it all comes down to being, we are all average before cost in this case and after. So we overrate. Second, or third, or fourth, I guess I am, individuals don't know enough to pay attention to cost, and they're so short-term oriented that cost doesn't seem to matter. You know, over an investment lifetime, that 2.5% cost in a mutual fund will in fact consume 78% of the return of the stock market. 78%. If you don't believe it, get out your compound interest table and take, for the purpose of argument, an 8% stock market return and a 5.5% mutual fund return, which is almost guaranteed to be delivered in that kind of a market after all those costs. So investors aren't looking at that long term. They're looking very much too short-term oriented. And I guess you'd finally have to say, make the grand concession, that indexing is not particularly interesting. It's been described as about as interesting as seeing paint dry, or even watching an America's Cup race, or watching grass grow. The only thing exciting about indexing is if you invest in an index fund and ignore it for your entire life, you will be so excited when you look at that statement when you reach retirement age, you will not believe how much you've accumulated. And I'll just add a little bit to that, and that is we had a little party, Dutch treat it was, got to be careful here, for the 30th anniversary of the underwriting. The underwriters actually, which was originally Dean Witter, had a party in New York for where all the people, there weren't very many, 10 or 12 people were involved in that first offering back in 1976 of the first index investment trust, now Vanguard 500. And the offering was a real bomb. Everybody called the fund Bogle's Folly. We could only raise, the underwriters wanted to raise $150 million. It was right on the mark with your question, Ed. It was very difficult to sell. I'm not sure the brokers really wanted to sell it, but they targeted $150 million, and we raised $11,300,000. It was a failure, and in fact, when I told the underwriters there wasn't even enough money to buy all 500 stocks in the S&P 500, they said, "Do you want to just kill the offering and give them their money back?" And I said, "You got to be kidding! We have the world's first index fund." And so we took it. Well, at this dinner, the lawyer, guy from Sullivan and Cromwell, back then, still there, I think, Steve West, got up to the way these dinners are, and he pulls out a little piece of paper out of his pocket. And he says, when I saw what a failure the end of the offering was, I thought I would contribute by buying 1,000 shares. And I've held it ever since. And this is my confirmation. And so I put $15,000 in on August 31st, 1976. And I take this to the investment committees that I'm sitting on. And I say, "Can you guys do this?" And the fact is that that investment was worth $471,699 the night of that dinner. $15,000 to $471,000. And in my book I say, and there's a number that requires no comment except this. And think about this one when you talk about the fund industry. Well, I believe the number is 310 mutual funds in business, and only 150 are still in existence. Think about that. Those numbers aren't quite right, but they capture it well enough. You can look at the exact number in the book. So it's that combination of factors.
Jack, we see high-profile investors, Harvard and Yale are often cited. You mentioned that Princeton has done quite well with your endowment contribution. My alma mater at Duke, we've got good returns, and many people around the table have above-average returns. Is this just a dream that few achieve at the expense of the mass public, or is it something that if you really focus and work at it, is an achievable dream?
Well, that's a good question. I've gotten to know David Swenson a little bit, and I asked him kind of the same question: Can it be achieved in the future? And David says, he probably said this to all of you. He's up in this, not too far from here, and he said, there's so much stupid investing out there that if you're just, basically common sense and do the homework, you can continue to win. It's achievable for a long time, and I don't doubt that for some investors it is, but it can't be achievable for all. And what worries me, and I hinted at this a moment ago, Ed, is that I think what we're exposing here is some of the weaknesses in the mutual fund industry, where we do so many things badly, we charge too much. Only in rare cases do we ever cut off the assets in a fund. When in the Capital Group, very, very good group of people, as good a group of people as exist in this business, say they're never going to stop the offering of their funds, and they have $1 trillion in equity now, and it's going to grow and grow and grow, and they will become large value index funds, or in another case, a large growth index fund. But we don't have the discipline that tells us to do what we ought to do in an asset gathering business that you missed. So I think the mutual fund investors, if they start investing intelligently, that will be a lot of weak money or dumb money, call it what you will, that will start to do a lot better, and that means somebody else will do relatively worse. I don't think there's much way around that. And when you think about it, and this may be some of the things that you do in your own work, Ed, and that is one of the great things about the mutual fund industry is, and we don't seem to recognize in the financial business that the market is in a sense a closed system in a very real sense. And that is, if you read in the New York Times today that money poured into technology stocks yesterday and poured out of bank stocks, was everybody buying technology stocks and nobody selling them? What? Was everybody selling bank stocks and nobody buying them? No, it just doesn't happen. There aren't capital flows in and out. But in the mutual fund industry, there are every day, and you can measure it. And we created 240 new technology funds in the last 6 or 7 years of the 90s. We took in $400 billion into 2 or 3 peak years in the market there, into aggressive growth funds that were in technology, internet, telecommunications, all those hot stocks of the day. And so the mutual fund investors do 3.5%, 4.5% worse than the mutual funds that they invest in, whereas we can do dollar-weighted returns. So if we clean up the fund industry, that's going to make all of your jobs a lot more difficult.
We hope that they stay terrible.
Yeah.
Any other questions for Jack? I'm sure there must be some. Yes.
Steve? First, an observation and a question. At the same time that the turnover ratio has gone up to 150%, in the industry, the average holding of a mutual fund investor is under a year, or about 7 months. So you've got a mismatch in some ways. The question I have is this: the fiduciary responsibility of corporate America to the shareholder seems to be under attack. You've got the M&A activities, but one of the most important things is something you mentioned in the very first part of your humble arithmetic: dividends. My question to you is not only the standing wisdom tree, and my dad got into business in 1951 as you did left for the board out of the company, was what is the role of dividends going to be going forward in terms of returns to shareholder value, and is the payout ratios going to go up back to the historical time when you got in business?
Sure. Well, I think you could all hear the question, and let me first say I think dividends are very, very underrated in terms of their impact on the market. I have these simple little tables in the book, and we had this 9.5% nominal return on stocks, and it's 100% from the creation of, no, actually 99%. The market return in the last 100 years has been about 9.6%, and the dividend, what I call the investment return in the book, dividends and earnings growth, have been 9.5 of that 9.6. PEs don't matter much in the long run, and that's 4.5% dividend yield and a 5% earnings growth rate. Today, the dividend yield is not 4.5%. It's 2%, actually less than 2%. So we should be looking at market returns, investment returns of 2% plus 5 or 6% if corporate earnings grow. I mean, this is such a simple business when you think about it. If corporate earnings grow at roughly the rate, the nominal rate of the GDP, has been true forever and will be true, it must be true, I think, forever. So dividends are going to contribute much less to investment returns in the future, which is why I think we have to project lower returns, which makes this whole cost issue more difficult. The only way you can change the dividend yield is there are 2 ways: raise the payout or drop the price. And if the stock market would drop if it dropped 50%, the 2% yield would go to 4%. And all would be well. I mean, I'm not looking for a 50% decline. Well, all would be well in a manner of speaking. But I think gradually dividend payouts will come up. And I might also make these are observations from my previous book, that dividends play a very unusual role in a society where it must be obvious that very few investors, or the vast majority of investors, are not investing for income. The average equity mutual fund has a yield of 0.3%. That's not magic. It's 1.8% market yield minus a 1.5% expense ratio. 0.3%. Investors just don't give a damn about it. And they're going to have to, sooner or later, care about dividends. I have some ideas about involving, bringing dividends into a more prominent position in view of the speculation in the market, because we know that the turnover rate of dividend-paying stocks, this will not surprise anybody, is only about half the turnover rate of non-dividend-paying stocks. And I have some ideas expressed in that earlier book about paying larger dividends to longer-term shareholders. Once you've held your shares for 2 years, give them another 10 cents per share. That's nothing the matter with that. To encourage long-term investing. Because a big part of the problem in corporate America happens to be the fact that these absentee owners, these 70%, 68%, 70%, don't really give a damn about corporate governance. And if the owners or the renters of stocks don't care about governance, kind of wondering who should care about governance. Yes, it's a singularly important issue. So those are just some reflections on dividend role in the whole picture. Yes, sir.
A little bit of a shift of audience, not the individuals, but in a lot of cases, pension schemes are underfunded. And you see some mad dash trying to get away from data, trying to pick a balance. I'd be curious, what's your view of these 130/30 programs that are getting a lot of attention?
Tell me what the
130/30 programs, it's a way to basically, without becoming a full hedge fund, to be able to short stock is still viewed in the context of a plan as being viewed as a traditional investment. So it's kind of a hedge fund light, if you will. And the fees are dramatically different as well.
Yeah, actually, I learned a long time ago that if you don't know the answer to a question, there's no law against saying, I don't know. I hope you forgive me for that lack of honesty.
There's more discussion now of actual funding, but a number of the public funds especially that are underfunded, that do not have the legislative approval to go into a full-blown hedge fund trying to buy talent that can see through,
Yeah,
are being able to now short stocks because these 130/30 programs are viewed as a traditional investment, like a stock and
Yeah.
an equity allocation. So there's an awful lot of consulting firms and state plans specifically, and some corporate plans that are looking at these as a way to get a little more alpha beyond just a beta exposure.
you know, every time I hear there's an easy way to get alpha, I put my hand over my wallet. But let me make a little broader comment about that. First, the state funds, we don't really know nearly as much state and local information about how badly off they are. But I think they're worse off than the very badly off corporate pension plans. But there was an very interesting article out of Morgan Stanley earlier in the year. And this is where I fault the investment community greatly in their rental stock rather than own stock thing. This obvious overstatement for a long time of what returns pension funds will earn in the future, which of course helps the present management increase earnings by making these assumptions, now averaging about 8.5%. And this Morgan Stanley study asked the 100 CEOs of the 100 largest companies in the country, what these CFOs, what they expected the future return on stocks to be. And their consensus answer, and it didn't vary a lot from one to another, was 6.11% is going to be the future return on stocks, even lower than cautious Bogle's number. When you assume 8.5% on your pension fund, you're basically assuming that stocks will earn about 12%. In other words, they believe that stocks will give about 6, and their financial statements show that stocks will give imputedly 12. And I think it's a great discredit to our investment community overall that analysts don't seem to press corporations on how they get to those, I would argue, outrageous assumptions. And there's no easy way to get there. You know, it's a lot like saying, well, the return on the balanced portfolio in the next 10 years will probably be around 6%, let's say that for the purpose of argument. That's not good enough for me, so I'm going to have to get more. Well, I don't know. That reminds me kind of somebody who's lost the first 7 races at the track and decides to bet everything on the long shot in the 8th race. It's not a good strategy. You can't reach out there and get something that the market isn't going to give you. At least we know that investors as a group can't, and indeed, the reality is worse than that.
I've got a follow-up to Ed Barstow point about Princeton. You said that Princeton we all know that Princeton's had much better returns than most of their peers over time, and they've used a lot of hedge funds. And you mentioned that they spend 400 hours betting on the hedge fund that they invest with, and 75 hours monitoring. Why would you then say that hedge fund funds are not worth a fee to do the same thing, with many of the hedge fund funds have actually better risk management tools than Princeton would have?
Well, I guess first, Princeton doesn't layer on the extra fees.
But it costs them money.
Well, it costs them basis points, and when you're talking about the layering I'm not sure there's a uniform fee schedule for funds of funds, but it looks to me like it's a 1% plus an incentive on top of the remaining, the incentives that go to the underlying fund managers, and that's a lot more than a few basis points. So I can only express my personal skepticism. I get all the wisdom in the world, but the mathematics make it very difficult for anybody to do. I don't know if you've seen the stuff that Mark Kritzman has been doing for Peter Bernstein, but he says if you put together a package of hedge funds in an 8% market, I think he uses, it's just one of the recent writings of his, you should expect about a 4.5% return, counting all the fees out and all that kind of thing. So we'll have to see. I'm sure there are some good hedge funds of funds, and I'm sure there are some that really are pushing the edges of intelligent investing a long way.
Jack, I'm going to send you our marketing materials. Yes.
I'd like to go back to a comment you made earlier about corporate governance, just philosophically. Why would a passive or index fund care about corporate governance? Because whether you're active or passive in governance, you're still only going to earn the index. And any active governance effort you make, other than maybe checking off proxies, is going to be a cost. It's going to increase your cost basis. So philosophically, why would an index fund care about governance, and maybe the indexation be part of the problem of this agency attitude?
Okay, that's a good question. Let me just say this. Compared to the active manager, you know, I guess it used to be called the Wall Street Rule, and now it's called the Wall Street Walk. If you don't like the management, you sell the stock. That's not an option available to an index fund. They can't sell the stock. So the index fund, and I'm speaking in theory here, and I'll go to the practicalities in a moment, the index fund's only avenue for increasing value is to, if a corporation isn't delivering a good return on capital, to get into the corporation and say, here are some things we want to make sure this corporation is managed in the interest of shareholders rather than the interest of management. We want to be careful about issuing all those options. We want to be careful of share buybacks, all that kind of thing, because they have no other recourse to improve their values. They're the logical people to do it. Yes, it has a cost. It's a pretty trivial cost. I think TIAA Kraft, which is basically the only real activist we have in, quote, our, quote, business, although we're in a little bit different business, spends a couple of $1 million a year at this activity. I mean, it's big. It can't even find it in their expenses, but still big dollars, no question. And what my idea was is to get not just index funds, but long-term investors in the mutual fund industry, of whom there are not very many, but to get them together and say, let's develop, we'll jointly fund an effort to do a corporate responsibility, I'm not talking about social responsibility, I think corporate governance maybe would be a better phrase. And let's all get together, pool our resources. That does away with, to some degree, with the free rider issue, and do it because we are the logical, long-term investors are the logical participants in the system. That idea went over like a lead balloon. I did get actually it's kind of a funny story because I did get a number of people into a room in New York 3 or 4 years ago to talk about this issue, including index managers, including active managers, including some of the better active managers in the business. And some people wanted to be kept informed, didn't want to be identified. Most people, but not all people there, didn't want to be identified anyway. It seems kind of funny. Don't tell anybody I went to your meeting. But the highlight is it's really responsive. It's a funny story, but it's really responsive to your question. And one of the participants, vice chairman of a fairly large investment firm, after we got to the end of this discussion, or coming to the end of the discussion, he said, look, Jack, I know what you're saying, and I know we all want to do it, but why don't we just leave it to Adam Smith's invisible hand? And I looked at him and I said, for God's sake, don't you know we are Adam Smith's invisible hand? And we are. And, sooner or later you got to stand up and be counted.
But we'll all acknowledge that we came to your meeting today, Jack. I think, Peter, did you have a question?
I did. It was somewhat related, actually. It was the disconnect between the lack of corporate governance and the view that you could be a passive investor. And it made me think a bit about active managers and also, frankly, the private equity industry being a representative of that field. Do you view private equity investing as a social or antisocial
Well, now there's a nice question. Where's George Bush when I need him? I guess, I understand the way the market works, and I view that as positive from a social standpoint and from an economic and investment standpoint, creating value. What worries me, and it worries me a lot, and we will never know as much about it as we should, is the management of that company is in a very peculiar and conflicted position. The manager has all the information. It's pretty easy to manage earnings, and you can manage them down when you want to go private. This is theoretically at least. And you can manage them up when you want to go back public again. And there doesn't seem to be an arbiter without a vested interest in the equation. And that's generally a situation where it's going to give rise to problems. And I'm not saying, I might say, but I don't know enough about it to say it's a systemic problem. But it's certainly, that's the big question I've had about all the private equity thing. How does it happen? Usually the CEO does okay in these things. But you could argue, and I'd accept the argument, that it's just what happens when you have a corporate merger. Believe me, corporate mergers don't happen when you say to the other CEO, you're out of here without a penny. That merger is not going to take place, I can guarantee you. But isn't that wrong? And of course it's wrong.
When you look at it from a management's perspective, I wonder whether that's Adam Smith's hand at work, though, if in fact you're going to improve your governance under private ownership, because in fact you've got someone watching the store.
Yeah,
Isn't it going to make the other public companies a little more honest, or they're going to face the same?
it could easily have that effect. And, there you don't have this, well, you're not talking about agents, you're talking about true ownership there. And I'm just trying to say that, I'm just saying that this conflict that deep down troubles me. We live in there's so many conflicts of interest that we have to handle, and not just in the investment business, but where money's concerned, conflicts of interest are tougher than, where little bits of money are concerned. So that's my concern. I'm sure it exists, but I have absolutely no idea whether that's the exception or something significantly more than that.
Yes.
One of the best definitions I've seen of fair market value is in the tax laws. Basically, the price at which a willing buyer, willing seller, neither having a compulsion to buy or sell, make a trade at. Talk about an index fund, say a Russell 2000 index fund. Many of the Russell 2000 stocks are very illiquid. And I know I personally have, benefited by knowing stocks are going to go out of the Russell, go in, and the index funds are going to be compelled to buy or sell. I've seen tremendous market variances based on that. Now, over the last few years, a lot of it's disappeared because people have tried to prepare for it, so you've seen kind of reverse trends. But the bottom line is I've seen tremendous transaction costs, something that would be quite disturbing to me if I was an index fund manager. And being compelled to own or not own a certain stock and have to go through a gate when everyone else is going would really trouble me. I wonder if you could, I see that as one of the problems of an index fund with a certain strata of stock, namely Russell 2000, where there's not the liquidity.
Yeah. Well, let me say I share your concern, and I'd even amplify it to say that the use of the word index fund now is, for the want of a better word, kind of gotten bastardized. The original classic index fund was the S&P 500 index fund, 80% of the U.S. market cap. Gradually, and eventually this will be the dominant strain of indexing into the total stock market, dominant for U.S. Total stock market index fund, which is the other 20%. The performance over time is identical, but owning the total market is, I think, arguably just more economically sound than owning 80% of it. So I don't think you need to desert the S&P 500, but the things work perfectly well in both cases. Broad market classic index funds, no transaction costs, no transactions, and so on. When you get into subsectors, I share your concern. We moved away actually from the Russell 2000 index about, I'm not an expert at this because I haven't run Vanguard for quite a few years, but moved away from the Russell index for the very reason that turnover is all concentrated, or at least was then, in one day in June every year. And the more I looked into it, I have to confess that I also started the first small cap index fund, and I never thought of, I'm not, I told you, I'm not the smartest guy in the world, and I never thought about the issue of turnover. I always thought the idea of owning small cap funds, small cap stocks, was to buy the portfolio and hold it. But of course you don't do that in a small cap index fund. You get rid of, when things get big, which is what you want a little company to get big if you own small cap stock, out it goes. So I think your question is well taken, and there's a lot of reason to think that we can do a much better job in small cap indexing and in all the small segment indexing that we now do. There are big variations when you get into these new ETFs, 4 or 5%, maybe as much 4 or 5% a year in the worst cases, between the index itself and what the manager can do. So, and yet the small cap index still outperforms. This is the crazy thing about indexing. The small cap index is a terrible index, and it still outperforms 75% of the small cap managers. And I think we can all agree that the S&P index, which is, they show you this picture of the committee managing the stocks. It's really a lot of, with all due respect, a lot of baloney. It has a 99.9 R squared, the S&P index itself, with the 500 largest stocks. Just in the abstract, the 500 largest stocks reweighted every year. That's what it really is. And you would think that by putting in these wild technology stocks in the late 1990s, which it did, the index is pretty flawed. And I would agree that it's flawed. And yet you quickly have to ask, Glenn, how can it outperform all these managers by so much with all those flaws? So one can only wonder about the future of indexing if we get a really good index. But it actually works out fine. The total stock market index is the more preferred one. But the subsectors, there are a lot of questions that ought to be studied and answered. And index managers should be putting pressure to make that a better index.
Question. Every time the market goes down, it looks like the newspaper articles issue more articles on increased correlation with international markets. Could you comment on international indexing or global indexing versus just U.S. indexing?
Yeah, I'd be glad to. So in international indexing, let's first take the basic. International indexing works better than indexing in the U.S. Why does it work better? Because the costs of international indexing are higher. The costs of international active management are higher. And I'm speaking of the mutual fund field primarily. We seem to think that international investing is so much more difficult. I never quite got this issue. I think it's kind of a make-weight issue. But we charge more. More funds have sales loads in the international area. More funds have higher fees. The turnover is higher than in the U.S. And turnover costs, as you know, abroad are higher. So long as gross return minus cost equals net return, it follows that international indexing, owning everything, discrete universe of international stocks, is going to do better than the average manager. There's no way around it. That is the way I would go for international indexing. An equally interesting question is, what about and this is a question more frequently asked, where does international fit into the U.S.? And I've been kind of slow, I think, to come around. I know I have, to international, because I first got thinking and writing about this in the early 1990s, when it was quite obvious that the dollar accounts for so much of the difference between the U.S. stock market and international markets, that it's really quite remarkable. And if you look at local currency returns, the international markets weren't really that good from 1975 to 1990 or 1991. It's just a very weak dollar, and it was intuitively satisfactory to say the dollar would be strong for a while, and it was. So I said you don't need international. I mean, after all, we're not in Fortress America here. 35% of the earnings and 35% of the revenues of U.S. companies come from abroad. But the more I think about it, the more I think I may have been too narrow in that approach. I think you should do some international, but I would never personally not do for a U.S. citizen, spending and earning in U.S. dollars. I wouldn't do the market sort, which is 50% international, roughly market cap, and 50% U.S. That just strikes me as not an intelligent thing to do. But maybe 20% international stocks. And I would say, if it were and I don't do this, I'm thinking about doing it after international calms down and after emerging markets calm down. But maybe if you have 20% international, maybe 10% in established international and industrialized international, and 10% in emerging markets. The risks are, I don't know, the idea of France, Germany, England, Italy, particularly, doesn't particularly appeal to me. I don't see why they're going to do any better than the U.S. And so I'd put a more than market weight on emerging markets, and put on some blinders and ignore the incredible fluctuations we're going to have as we go along.
Yes.
There's been some talk, I guess, in at least some of the theoretical discussion about different ways of creating indexes as opposed to market weighting, perhaps weighting by sales or earnings as a means for better capturing the market portfolio. And I don't know whether you've thought about that or whether Vanguard has those types of products, but I'd love to get your reaction.
Oh, I'd love to talk about that. I actually have a chapter in the book on this. It's like every other chapter, kind of fiery. But I don't buy it. When someone says the fundamental indexing argument is you weight stocks by their revenues or earnings or cash flow, or I think he's actually all three, is Rob Arnott, or weight them by dividends. This is Jeremy Siegel. And most people, I'm just reading an article by Fama and French, who say the worst strategy you can do is dividends. That's by far the lowest premium strategy. I don't know if Jeremy Siegel read that or not. But
He's revising his paper.
Revising his paper. But I just don't believe that there are new paradigms, and I don't believe that the relationship of value to growth over time in the mutual fund field is a little bit different when Fama and French do with their back testing. But if you look at the mutual fund field, there have been growth and value funds pretty much separate since the mid-1930s, believe it or not. Not very many, but they're clearly identified. You can look at their yields and all that kind of thing. And we've had this study going for, I did the first one probably, I don't know, when I was 25 or 30 years old, and it was a long time ago, and we keep this up. And there are times when growth does better, and there are times when value does better. So you want to be an indexer, and you want ETFs to bring the brokerage community into the distribution. So that's why they both of these fundamental things use the ETF system, which to me implies that trading these funds will give you a better return than not trading them, because there they are, where you can trade them all day long. But my logic tells me that to say there's something that has been permanently undervalued, was undervalued consistently in the past, and will permanently be undervalued, it just strikes me as not right. If as I say to Rob Arnott, if you're right that they have been undervalued in the past, then you're wrong, because they won't be undervalued in the future. In other words, the market is this great, fantastic, our stock market, fantastic arbitrage, ability to arbitrage the past and the future. So when you take into account all their back studies show maybe a 1.5% gain, you can pay 1.5% for one of those funds very easily. And that assumes that you'll break even if the distance persists. And these are all paper studies. How are they going to implement these programs? Never, you all know enough about this. Seeing stuff done on paper, everything works well on paper. And it is a kind of a data mining, back testing thing that they're doing, because they didn't bring them out. Think about this, and this gets to the mutual fund industry generally. Do you bring out these funds in 1999, the perfect time? No, nobody would buy them in 1999. They've lagged the market, right? And they've lagged it seriously for 5 or 6 years. So you wait. I'm putting myself in there. You wait and you wait and wait, and then the obvious happens. Having lagged for so long, they win. And so you bring them out in 203 and 204 and 205. And if you look at the charts that Jeremy Siegel's marketing material has, and you look carefully, the 100%, more than 100% of the advantage of the dividend model was achieved in 3 years. 3 years out of 45. That would be 2000, 2001, 2002. So I don't buy it. I don't have a particular vested interest. Vanguard could start them. The people at Vanguard, sometimes I disagree with. Sometimes they disagree with me, and sometimes they agree with me, or is it vice versa? But they share my view on this. They're very. They don't believe there is a new paradigm. So I'd say handle with care, like everything else.
We have time for one more question. There.
Vanguard, obviously one of the leaders in the retirement business. There's a lot of people here that probably have some investments I do. A lot of hedge funds in the room. My question is,
there are no hedge
do you
funds.
see a convergence or a place for hedge funds in serving the mass retirement market? How do you see that transpiring?
The market is so imperfect. The distribution market for financial services is so imperfect that I think we ought to be very careful in basically the creation of, quote, new products. The new products, and that's a word I banned at Vanguard all those years ago. I think it may have come back, which is too bad, because I don't think you should think of a financial service or a trust service as a product, for God's sake. And I don't think you should be in the marketing business, because marketing, you don't have to be a genius to know what marketing is. Marketing is to find out what the public wants and give it to them. Is that what that have anything to do with investing? So the investor has kind of a stacked deck. The distribution system is out there with all that extra information. The distribution system is going to focus on, inevitably, what's done well. You're very smart, Ed. You're focusing on what does badly, and that's a strategy that probably works, or it certainly worked for you. But to focus on what does well, what's done well recently, what's hot, what's not, it's just the wrong way to run a railroad, and it's certainly the wrong way to run a mutual fund industry. So I'd say if we could only give investors less choice, so much the better. And I'll just say quickly, parenthetically, that I think one of the things the Bush administration did right, although they never had a formal recommendation, was to follow the model of the federal thrift plan and their Social Security privatization plan. And that basically, I would have less choice than they did. Because the investor, you all know this, I think, the investor is his or her own worst enemy. Or to quote the great Buffett, the two greatest enemies of the equity investor are expenses and emotions. And so, just buy and hold and get things as broad as you can, and you will do well. Maybe you could do better. Maybe you could do better, but you will do well, and that's good enough, I think, for the vast majority to capture the returns that our financial markets are generous enough to deliver.
Well, thank you. On behalf of the Greenwich Roundtable, where all members are above average,
Thank God.
I'd like
Like Bogle.
to thank you for your comments.